This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
The archives.
Episode 169. Can MMT work in countries with a trade deficit?
Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Today we look at modern monetary theory, MMT, which tells us that we shouldn't worry about government debt, that governments can create money to spend on projects that are going to create full employment. Well, even if that is the case, what happens when the money you need isn't in your currency? You can't create foreign currency, can you? So how does modern monetary theory work in practice? For small countries that need foreign currencies to buy the imports they need to grow their economy. That's today on the Debunking Economics podcast. Now, Mario Draghi, as he steps aside from the ECB, has suggested that the central bank in Europe should look at new ideas. They've tried everything else. New ideas like modern monetary theory. He used those words. He talked about it when he was speaking to a European Parliamentary Committee in late September. Not a job for a bank, he said, of course, but something for the governments to look at, perhaps because he doesn't know what else to do. But Japan doesn't know what else to do either, which is why they have been allegedly looking at MMT too. And look, with $22 trillion in government debt, you could argue the US has been practicing it too and doing better than most economies. So, Steve, is it an idea whose time has come, do you think?
Well, this is the intriguing thing. The fundamental basis of MMT is simply a factual description of the government's role in money creation. And I extend that by having my own factual description of the role of the private banking sector in money creation. Of course, where I differ with modern monetary theory, and it's just a case of I think they haven't thought it through themselves properly, not that there's a conflict, is that they underrate the importance of private bank money creation and say that the whole endogenous money literature, to quote Randy Ray on this, has had a trivial impact. I believe that's completely wrong. But when you bring in the case that it has non-trivial impact in terms of the macroeconomics, it strengthens the MMT case overall.
Yeah, because as we discussed in the recent episode, I mean, 97% of money created is being created by commercial banks.
Yeah, that's the part that people with positive money want to end, and say should all be 100% created by the government. But in both cases, what you're getting is an acceptance that the government doesn't have to it doesn't have to tax in order to spend. Yeah. Whereas you and I have to work in order to get income. The government, we have to earn before we can spend. Yeah. What it's saying is the government can spend before it earns because it is the currency issuer. And then once you take that into account, there's all sorts of complicated mechanics in that. And often those mechanics are imposed by laws, by legislatures that actually want to restrict what governments can do and see that as a good thing that they put those restrictions on. But what MMT fundamentally starts from is say, well, let's look through the veil of those restrictions, first accept the overall legal reality that a country's government is a sensible country's government, which of course leaves out about 23 countries in Europe, but a sensible country's government creates its own currency. And thereby creating its own currency, the only way that currency can actually be spent, if you go back to look at the foundation of the United States, the only way that currency could be taxed back in by the government was if it was created by the government in the first place. Yeah. And that's the I think probably the best point is to go back to an ab initio case like that and say, when did the greenback originate? Did the Washington government start taxing people in greenbacks before they created the greenback? I'm sorry, there's a slight technical problem in doing that.
Right. So governments create the money. I like that argument. I mean, it makes perfect sense, doesn't it? If you look at which came first, the chicken or the egg, well, the greenback definitely came before tax.
Which meant the spending came before the taxation.
Right. And the role of government then is to, I mean, they can, in theory, then create as much money as they want, subject to inflation. If they do it too much, then obviously you're going to have runaway inflation. But the target is to reduce unemployment. So if there's unemployment, there's not enough investment in the economy, in other words, so the public sector should spend. But the argument is, of course, as well, does that public spending crowd out spending that would otherwise have happened by the private sector? Is there a danger that if you pursue this, you're going to stop innovation, for example?
Yeah, well, I mean, that's the I'm actually trying to backtrack a bit here to the actual issue of government spending itself and what that means. Because if you say if you start from the perspective that says this government has to tax before it can spend, then you're putting the government under the same effective constraints as you put out a household or a business under. You must earn money before you can spend it. And that means that your budget constraint is a major, major issue for you. And who's McCorber from from Charles Dickens, the expression, what is it, income £20, expenditure £19, 19 and 6 is heaven, and income £20, expenditure £20 and 6 pence is hell, something of that sort of statement.
Yeah, you're not going to get it from me.
Okay, sorry. Long time since I've read Dickens.
Yeah,
but that is the situation of any private institution. But for the government's point of view, once you say the government has to spend before it can tax the money back in, then it no longer faces that constraint. It is not constrained by its budget in the same sense that a household or a firm is.
But understanding all of that, but I mean, the practicalities is how it works. Is if the government spends, then that gets counted as, I mean, perhaps we're wrongly terming it, but government debt, because basically the government issues bonds to cover their spending, and that's where you get this. That's where you get this crowded out issue. So in theory, they could keep on doing that. They could keep on issuing bonds, and in fact, we're even getting a Conservative government in the UK talking about that now, saying interest rates are so low, let's start spending. And because why not? Make the most out of the opportunity. But the Conservative government would normally be arguing when they weren't politicking like they are now that the danger of doing that is that it crowds out private sector spending, because who is going to buy, for example, equities or bonds in a private company when you can buy government debt and that's always going to be repaid? Isn't there a danger that you by following this argument you get almost towards a communist situation where the state will control everything?
Well, then, my God, mate, you've summarised the entire Republican Party debate, and Democrat for that matter, unfortunately, in 2 sentences. So congratulations.
Thank you.
But this is partly the problem. It's a classic discussion between somebody who is a proponent of MMT as a way of analysing the economy rather than saying what the policy should be as a result of that, and somebody who's against it goes, government spend more than it gets back in taxation, but Zimbabwe.
Yeah, always brought up. Yeah.
And all of a sudden, okay, let's get there in a few steps. Okay, let's just gradually, let's not leap straight to Zimbabwe straight away. Let's just get there and say, why did Zimbabwe compare? Whereas if you look at America, and this is why I like to stick with American data as much as I can, if you look at the, just a quick technical question here. Do you regard 120 years as a long time?
Well, it depends what you're talking about, doesn't it? I mean, it would be a short period to the next ice age. I'd be worried about that.
Not in the scheme of human evolution, but in the scheme of... Okay, so 120 years, I think we take as being a definition of the long term. And because economists make a lot of the song and dance about saying, well, this applies in the short term, but in the long term, this has to apply. Well, that's exactly what they do about government spending. If you read, and I unfortunately have read, the papers of people like Robert Barrow, which gave us this whole idea of what he called Ricardian equivalence and all the travesties that led to completely ignoring the financial crisis, yada, yada, yada. They start with saying the government must, over the long term, must make sure that it's the net present value of its expenditure of the gap between government spending and government taxation is zero. That is a built-in assumption to the paper that gave us the idea of what they call Ricardian equivalence, saying that any government spending necessarily crowds out private sector spending. And as we all know, the government must have a net zero balance over time. That's the starting point of that thinking. Now, when you look at the American data, then that should be turning up in the American data. Over long term, it should be zero. The actual value, in terms of the difference between its income and its expenditure, between taxes and spending, is minus 2.4% of GDP. In other words, for the last 120 years, America has been spending roughly 2.4% more than it's been getting back in taxation. Now, if you take out the big events like the Second World War and the First World War, it falls, of course, to 2.2%.
Wow.
Okay. When you take out the warp, it's still of the order of 2% of GDP per annum on average over 120 years. Now, call me crazy, but I'd like to base my economic analysis on the data.
But that would mean then a widening. The terms that are used today. That would mean a widening budget deficit, a widening government deficit.
Pretty much that's the average. That's the average scale of the budget deficit, 2.4% of GDP.
Oh, okay.
Okay, so in other words, it's been doing that for 120 years. Now, Zimbabwe, what's been the impact on the rate of inflation? Well, at the moment,
thousands of percent.
It's barely scraping above the 0 point. And of course, you go back, you can find, of course, in the 1980s, and this is the period that I think scarred conventional economic theory and, for that matter, progressive theory very badly. The period of high inflation leading up to the Volcker recession. But that's when most economists who are of my generation, thankfully starting to retire, not die as Max Planck recommends, but still retire, they were scarred by that experience. And of course, their whole thing has been fighting the war against inflation. Well, they've won, and it's now about running below 2%, and they're struggling to push it up to 2%. But if the argument that running a budget deficit will give you Zimbabwe applied, and you apply it to America, then in particular Zimbabwe has inflation of virtually zero after 120 years of consistent budget deficits.
But won't you get to a point, though, if you do keep on creating money willy-nilly, that you will devalue the currency and that will create an inflation, and there will be a point at which the extra creation has a negligible impact on the money supply. Because
and that then is what MMT says. The constraint of the government faces is not that it has to tax before it can spend. And again, that's where the foundational argument of going back to the first Greenback makes that point fairly easily. It's that it's what's the practical impact of its spending. Now, if you imagine, if you could take yourself back to the Second World War, the beginning of the Second World War, and here Britain's a better example because, of course, it was it didn't have an option of delaying its involvement there. When Britain began the Second World War, the budget deficit in 1940 was 40% of GDP. Now. Right. Okay, if you ask people what do they remember from the beginning of the Second World War, it's not inflation, it's rationing. So that 40%, they couldn't buy everything that you could be able to buy with your incomes. The money was being rationed so that everything went to the war effort instead, and individuals had to save the money that they fundamentally couldn't spend because you couldn't buy, you couldn't buy coffee, you couldn't buy tobacco with, you couldn't buy more than one pack of tobacco, et cetera, et cetera. But the huge budget deficit then did not cause the wall to fall in, and the reason they went to 40% was 39% may save you a bit of money, but it also meant you have to learn German shortly. So.
Which is,
existential threats throw this particular argument against government spending out the window. But what was realised by Americans in particular, and Barnsley Rummel, who at the time, maybe because of the weird name, was head of the US Federal Reserve, and a range of other economists as well, realised that during the Second World War, the government's capacity to create money enabled it to marshal the resources of the economy, first of all, to bring about complete full employment, so much so that they had to recruit women into the workforce to replace the men who were fighting on the front lines. And then that's where the whole Rosie the Riveter thing came from, which, of course, was turned into suppression of women in the 1950s. The Pickwick Wives, whatever they called it. That huge boost to point them out that the capacity of the government to create money meant it could marshal as many of the resources of the economy as it wished to marshal. But the point of the MMT comes back to, well, what are going to be the consequences of that? And yes, if you did massively boost government spending all the time, say, for example, to the scale of 20% of GDP as the government deficit, and you happen to be, for example, running a trade deficit also of 20% of GDP, and here I'm thinking specifically of Turkey, then what will happen, yes, the government money creation goes massively into buying imported goods. You start having to borrow in a currency which is not your own because people won't accept the Turkish lira, except that you have to convert the Turkish lira into American dollars to buy goods at all. People are not going to have confidence that you can generate, because you're running a huge current account deficit, they don't have confidence that you can actually service that over time. You have a currency crisis for the lira, it falls in value, and bang, the economy falls over as well.
Yeah.
That is a danger. Okay?
But you don't, supposedly you don't get into, and that I want to get onto that whole influence of, the externalities, because it's easy to look at MMT and convincingly argue the case, isn't it, if you're in a completely closed economy. And look, if you've got resources which are underutilized, which of course is what the case is, if people are out of work, then you can't have inflation through too much demand, can you? Because there's always going to demand that's going to be there if the resources were utilized, if everyone had a job. I mean, that's the base theory behind it all, isn't it? If you've got people who are out of work, then you're not going to get inflation until you've got full employment, basically.
Yeah, and that's why they say the real constraint should be full employment and inflation. It's the practical, is again back to the Barnsley-Rummel point and others from that time after the Second World War experience. The constraint on the government is the effect of what it does, not whether it can raise the money in the first instance. So they say you should be looking at what is happening to inflation, what is the level of employment. Those are important issues.
Yeah, and what about interest rates as well? Because there's going to be a tipping point, presumably. If I issue bonds and pay 5% interest and the central bank buys them, but inflation is up around 10%, then the bond is worth less than cash. So that's eating up central bank reserves. So there's a risk that they're going to be pushing up interest rates, isn't there? Which is going to potentially reduce private sector investment.
Well, this is again, there's a whole lot of technical, statistical stuff one has to do here. And I'll give I'll start with that one first of all. One of my old, very good friends, unfortunately deceased in recent years, Colm Kearney, was an Irish economist working in Australia who specialised in looking at what he called the crowding out hypothesis. And this is the argument that government spending crowds out private sector spending.
That's the point I was trying to
get. You get that in a very refined version in the so-called Ricardian equivalence bullshit. Pardon me using a technical term here, bullshit that, did I say bullshit?
Yeah, no, you were more specific than that. Ricardian bullshit. I think
Ricardian bullshit.
Yeah, I'm happy for those two words to get together.
Okay, Ricardian bullshit put out by Robert Barrow, and it literally said that every single cent of government spending is offset by an equal reduction in private sector spending. And this is on the argument that, and you read this stuff, and I think, I spent a lot of time in Amsterdam.
Yeah.
I haven't found anything this mind-bending here yet.
I mean, you're not smoking enough. I mean, but actually the counter-argument to that is very clear, though, isn't it? Because that would be like saying, well, if the government invests in infrastructure, that's going to stop private sector spending, where the whole reason for that investment in infrastructure was to facilitate private sector spending.
And this is what Colm can. When Colm did the statistical analysis, both in America, the UK, and Australia, he found what instead, empirically, there was crowding in. In other words, when the government spent money, for example, on building a piece of infrastructure like a highway between, let's say Los Angeles and San Francisco, then wow, my God, how amazing! Taco Bell and McDonald's and Shell
set up every 5 miles along that.
So the government investment actually spiked a level of private investment, and again. Because this is the thing, there are positive feedbacks between these things, not all the time negative feedbacks. But if you have positive feedbacks, they can go into overload. And this is what's, I actually prefer to call positive and negative feedbacks amplifying and dampening forces. But if you put government spending in, it will often amplify private sector spending. Now, a combination of two amplifying events can go into overload. This is what happens when you go to a concert and somebody puts the microphone too close to one of the speakers. The amplifying feedback between the speakers and the microphone goes whoop, and everybody's ear explodes and the system breaks down and you start all over again. So it's the potential for those amplifying feedbacks that are the danger. And if you simply respond to that by amplifying yet more, and you're a country like Zimbabwe, then that's when you do end up in that loop.
The smaller the country, the more likely you're going to hit the sort of the tipping point where you have put too much money into the economy. I mean that is given as the reason, isn't it, for hyperinflation in Zimbabwe?
Partially,
because they printed too much money and they got into this downward spiral.
It wasn't just printing money; it was also wiping out white farmers and
didn't help.
But what it looked like, it was supposed to be, a progressive movement, but what it meant was people who expertise was lost, and the productive capacity collapsed, and of course you also had, Mugabe handing out resources to his cronies and so on and so forth. That's that, and of course with the Weimar Republic, it was the complete devastation of Germany after the First World War and the reparation terms that France forced upon them, which were designed to destroy Germany permanently. That had a little bit to do with the fact that hyperinflation resulted. So that's the basic argument of MMT against it will always cause inflation. And I think that's why I use the American case as well to say, well, 120 years of moderate government deficits sustained over time have not caused private sector crowding out, have not caused runaway inflation. And that's why they say it's got a functional argument. And of course, what we're seeing now, people like Draghi, is that they have ignored all this stuff. People like Draghi were raised on the neoclassical Kool-Aid that was put into a refined form by Robert Barron, and this idea of Ricardian equivalence, that any increase in government spending is perfectly offset by a fall in private. But the reality is that when they apply those theories in the real world, and of course living in the European Union, they're forced into a fiscal compact to keep deficits below 3% of GDP and government debt below 60%. Those constraints mean the government spending hasn't been at the scale that the Americans have done over the last 120 years. And why? How strange. Europe's in a recession.
And so everybody is now saying, yes, the only way out of this, whether you call it MMT or not, is saying that the answer is not a monetary solution, it's a fiscal solution. In other words, governments have got to start spending. And that seems to, and Boris Johnson is now saying, yes, in Britain we need to start spending now, and he's promising all of this investment after all of these years of austerity, and his excuse is interest rates are low, we can afford to do it. But it is government spending. Basically, it's MMT. It's just a question of whether you pay it back or not is the open question mark.
Well, the open question mark, again, is answered by the American data and indeed for the British data. If you go back far enough in Britain's history, there was a time when government debt was over 250% of GDP. This, of course, Britain was an impoverished country known as the British Empire. It was actually at the peak of their victories over Napoleon and the growth of the extent of the empire in which the sun never sets, et cetera, et cetera. That was when the debt levels were that high. And equally, America's debts were enormous after the Second World War for the obvious reason of financing the Second World War. And over the period from the 1940s to the 1970s, that level of debt fell, even though America during that time hardly ever ran a surplus. It was the economy was growing faster than the extension of the interest on government debt. So it's feasible to pay this amount down, even though you sustain a deficit all the way through.
If you are a big country, the question is what happens in smaller countries. So I've got I'm a small African country, and I've got a very unstable currency. So how does MMT theory work in that scenario? Because I want to increase spending, but my inflation rate's already high. Unemployment is already high, so I issue bonds in US dollars rather than my own currency. My central bank can't buy them without, of course, paying for them in US dollars. So the interest has to be paid in US dollars. So I can't print money like I can for my own currency. Maybe I can print my own currency to convert to pay in US dollars, but of course I have to cover the exchange rate, and the exchange rate will make it get worse and inflation could get out of control. So how does MMT theory, it's useless in this scenario, isn't it?
No, but this is actually where I point. To me, my way of thinking, there's a contradiction in MMT at this point, and this is one thing I'm not going to be able to resolve until I sit down and build a complete Minsky monetary model of a multi-currency economy world. But MMT's argument in that particular case, and I'm sure I'm going to get corrected by complete MMT advocates here, is to say that their arguments only apply so long as you have effective sovereignty. That your currency and the sovereignty is defined in the fact that effectively your currency is accepted in international, not for international trade itself, but nobody's worried about your currency collapsing. Now, MMT throws in this additional argument, as well as saying that the government, rather than the government having to tax or spend, it says that the government spends and then taxes back to bring excess money creation out of the economy. The argument, and this is something that comes from Warren Mosler, exports are a cost and imports are a benefit. And this is another argument, and I think this is completely wrong. I've had this argument a few times, but that notion, I think, contradicts the fundamental argument about MMT, that you government spend in order to spend before they tax. It's all about the government effectively creating the money that the rest of us use to spending. And if you're running a trade deficit, then and part of that trade deficit is you buy a Mercedes-Benz, or you being somebody in Uganda buys a Mercedes-Benz, then the bank account in Ugandan dollars goes down, the bank account in Mercedes-Benz goes up as a result of that.
But who's going to sell me that Mercedes-Benz in Ugandan dollars? They're going to say, can you pay in US dollars? And that's part of the problem.
So the MMT's argument in that case is to say that the Ugandan is not as sovereign because its currency is not as trusted as widely as the American, et cetera, et cetera. I just simply say there's been a monetary transfer. And to me, the most important balance to maintain is not the getting a government, not to try to have a government surplus, which is the conventional austerity argument, but to make sure your foreign account is at least balanced. And this is one of Keynes's arguments during the formation of the Bretton Woods Agreement. He wanted to guarantee as best as possible that trade deficits were small and trade surpluses were penalised, because he saw countries running trade surpluses as getting an advantage over those running trade deficits while simultaneously depressing global demand. His argument was that if you are running a surplus, you are effectively using international trade to generate a financial surplus, which you can reinvest in your own economy, and therefore you grow faster.
Well, what's wrong with that? I mean, that seems like a logical explanation to me.
But it's the opposite of what MMT says. MMT comes out saying exports are a cost, imports are a benefit. I think that's bullshit. Pardon me. I won't bother making an argument about it in public because MMT is being very successful.
Right. But if my currency is not considered as trustworthy as the US dollar. And so people are not really prepared to buy and sell bonds in my currency. So I can't basically issue my own currency. The only way around that, surely, is import less and export more.
Sell local assets.
Preferably not. But you want to do something to bring in that foreign currency.
Well, that's what you have to do, and MMT people ultimately do say that if you do too much of this, then bad. But the starting proposition, they're still trying to squeeze in this argument that exports are a cost and imports are a benefit, and the country importing a goods hands us over pieces of paper or monetary claims on itself in the future in return for physical goods now. I just think that's nonsense. I had this discussion with Warren Mosler some time ago.
So the logic behind that is that
I don't think it is logic. I think it's a saying that has become ingrained in MMT,
right? And
I would like them to remove the saying. And I'm not going to. That's one point I'm very happy to say I can.
Well, they say that they're saying as we import, we're depriving other nations of the resources that are used to create that product, and we're getting them. And if we're exporting them, we're giving up resources from our country. But you aren't getting paid for them as part of the process.
You're reinvesting and so on. So I think that to me is the furphy in MMT. But the fundamental argument, the monetary argument they make about the domestic economy, I think are quite valid. And what you've got let's go back to why it's becoming raised now. You mentioned Draghi in the beginning. You have countries, superstates like the European Union, that have lived by the neoclassical hymn book. Saying that the government should not run a deficit, with the target actually of the Maastricht Treaty and the Lisbon Treaty for governments on the average to run surpluses. And MMT's point is if the government sector is running a surplus, then the non-government sector is running exactly the same deficit. And that's simply saying you divide the world in two halves, and you have one half which tries to spend less than it gets back in. So government spending is less than government taxation. By definition, by fact, that means they're taking more out of private bank accounts than they're putting back into them. Which means the government tries to get on a surplus, it necessarily forces the non-government sector, resigned as everything else apart from the government, into a deficit. And that is the question is, well, can the private sector sustain an indefinite deficit? And the answer that any of us have been in that situation who've tried it for long enough is no.
Yeah.
But either borrow money or you go bankrupt.
And yet so many countries that have got these big foreign debt liabilities are being forced by the IMF and by the EU to follow these austerity-type policies, reducing government spending, borrow from the private markets, control the circulation of money. It really is the antithesis of MMT, isn't it, really?
Exactly. And that's the point that people make about Argentina. Rather than Argentina being a criticism of MMT, it's showing that MMT is correct on that front, because the policies that it's been enforced into have encouraged the private sector to do everything that MMT says it will do if the government's taking money away all the time. And if you look at some of the reports recently, of course, people have got United States, American dollar bank accounts in Argentina. They're going into Argentinian banks and demanding and exchanging their Argentinian currency for American dollars. There's claims that there's something of the order of 50 to 100 billion dollars in US notes stuffed under mattresses in Argentina. This is all in response to the fact that the government running a surplus it causes the private sector to run a deficit. Yeah. So it's saying that, and what you see with people like Draghi is, having seen that, thinking that was a good idea, they now get to the end of their term, and what do? They come out and say, gee, maybe it was a bad idea. And
maybe he feels like he can say what perhaps seems a little bit more obvious to him now. But the other side is the action of rating agencies like Moody's that are, putting sovereign debt at basically determining what the risk is, so that if you've got a high level of sovereign debt, then they say, well, this is high risk. That puts yields on bonds ridiculously high, so more money is obviously then spent repaying that debt. If you create more money to cover that, then you get more inflation. So no money used is actually going to get us anywhere. So you look at places like Mexico, for example, a triple B rating. It's got an interest rate over 7%, paid on 10-year government bonds. And of course, in many places it gets much higher than that. And it's all down to ratings agencies that look at sovereign debt. So they're not, if they were to adopt the modern monetary theory philosophy, maybe they'd be rating everybody slightly differently, because that is a big problem, isn't it? How it creates interest rates.
Yeah, and then that's a huge issue. It's actually our rules about the monetary system that are causing the trouble, rather than the monetary system itself per se. And this is again back to Draghi's conversion on the road away from Damascus. This has happened to Victor Constanzo as well, who's another member of the ECB board. I had a discussion with him in a panel meeting in the UK about 4 years ago now, and he was, softly but not emphatically defending the European Union position. As soon as he leaves the board, he starts talking about the need for fiscal spending. So what they've had is they've been trying this idea that the government should run a surplus. What it's generated is a state of depression. The monetary authorities have tried everything else to try to reflate the economy with the tools they have at their disposal. It hasn't worked, and now they're coming out and saying, "Oh, maybe we should adopt these new ideas like MMT." It's showing that if you defy reality. And that's what MMT and that particular basis is based upon. If you save, somebody else has to just save precisely as much. If you don't take that understanding into case, you are going to end up stuffing up your economy, and that's what the European Union has succeeded in doing.
And yet, haven't they got the biggest opportunity? If we say that one of the problems with MMT is that it doesn't work so well in small countries with weak currencies, because you really can't generate too much of that currency, because you've really got to start issuing your debt in stronger currencies like the American dollar, then that would be a good reason to say, well, okay, let's take a whole load of weak currencies in an area. Let's take 27 nations in Europe, for example, and they didn't all join the euro, but if they did, then you wouldn't have that issue of weaker currency. They'd all be part of a strong currency. That could be a benefit of the euro, couldn't it?
That's partly the philosophy behind forming the euro, but it was also married to the idea of austerity at the national level. Yeah. The only way it would have worked would be if you had a European government whose expenditure far exceeded the expenditure of the European states, which had become like the American states. And then your taxation was to this European authority rather than to the nations of Europe.
And this is the problem, isn't it? So the idea of what the central bank does is cut off
matching treasury.
Yeah, so you all, which is it is what everyone doesn't want to have happen, which is the European Union takes more control and loses the sovereignty of governments in terms of spending. But if there's a way that the central bank could be involved in creating that extra budget for, if they could be injecting money into the regions of Europe, then that could work, couldn't it?
Well, that's the argument that Yanis Varoufakis first put forward in what he called a modest proposal way back in the early days of the European post-financial crisis to say that we could actually use purchases of the infrastructure bank bonds issued by the infrastructure bank, fully backed by the European Central Bank, which could have enabled that sort of investment and re-stimulated the economy of Europe and got it out of the crisis that has remained in ever since. So it is feasible. But of course, it's far easier when people accept, as they do in America, that tax dollars are paid from Alabama to Washington and California to Washington, and then spending goes out from Washington to Alabama and Washington to California, and overall, effectively, California is subsidising Alabama, but nobody knows because the records simply aren't kept. And frankly, nobody cares because they've got used to the fact that it's the national government that is by far the largest spender than the states.
It's a good old US of A. I mean, just so long as it's for the national good, but which is obviously a very different philosophy in Europe, where each to their own. They want to be part of Europe, but they also want to get the best out of it. But what about when you look at countries like continents like Africa, where you've got a lot of small countries? Many depended on the US dollar. How could modern monetary theory work in situations like that?
Well, it's the realism the government can spend to finance its own expenditure in its own currency, so long as it has sovereignty in the sense that its currency continues to be accepted in its own country. And of course, that's not the case in Argentina anymore. It wasn't the case in Zimbabwe. People were, it's the black market in US dollars that takes over. It's really, again, that's why I come back and saying it's so important to have certainly for developing countries, to not face currency crises, to not have a current account deficit that can trigger a currency crisis, and that wipes everything out. And so that my feeling would be, and of course with the developing country, you're going to be importing your capital goods. You're not going to be making them domestically. So you're going to have to buy those things until such time as you build up a local industry. And that again comes down to a question of scale as well. Do you have a large enough economy to do it? Would it make sense in some cases?
Nigeria should be the job of the World Bank then, shouldn't it? How do we capitalize these countries so that they can develop economies which can be self-sufficient?
And that was again part of the Keynes's proposal with the Bancor and the IMF, if he wanted to exist, that countries running a trade surplus would end up being penalised, and part of that penalty of taxation for the surplus would be used to finance the investment in capital and infrastructure by the developing nations. So because not having that world, and we're caught up with the immaturity of the system the Americans forced upon us. We don't have that capability. So the MMT argument, I think, makes sense. It's a description of how money actually acts in the economy. You have to supplement by the role of credit, which is left out of the argument at the moment. It doesn't have to be left out. And you've got to, I think, change the argument they have on foreign trade, because I think that's simply wrong. And everything should be explained in a monetary way. The exports are a cost, imports are a benefit as a non-monetary injection into what is fundamentally a monetary theory. And I think it stuffs up that theory.
All right, look, do you know what? If you listen to all of these podcasts, they all do piece together somehow. We have the answer to the world economy. You just got to listen to all the episodes and join them together in the right places. And I think we did.
Only about 250, aren't there? It's already
something like that. It's going to take a while. That's right. Look, next time we're going to talk about the 4-day working week. That's something that the Shadow Chancellor, John McDonnell, was talking about a few weeks back at the Labour Party conference in Brighton. Is that a good idea? We'll talk about that next time. Thanks, Steve.
Okay, right, good.
And we'll see you all for that one. Thanks for listening. I'm Phil Dobbie. He's Steve Keen. Back next week. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.